In recent economic developments, the stock and bond markets are rallying ahead, seemingly beating the uncertainties that loom around rate cuts anticipated by the Federal Reserve. Financial analysts and market observers, however, warn that it's wisest not to get swept away in the enthusiasm just yet. The Federal Reserve, as the central bank of the United States, exercises significant control and influence over the economic trajectory of the country. One of its most potent tools, altering the federal funds rate, can have wide ranging repercussions on the economy, affecting everything from consumer spending to investment decisions, prompting significant market reactions. Indeed, the stock and bond markets have been on an upward trajectory, seemingly undeterred by pandemic jitters and unfazed by inflation concerns. In recent weeks, indicators such as the S&P 500 and the Dow Jones Industrial Average have been on an upward trajectory, marking notable gains. The bond market, too, has been shining, with falling yields suggesting that investors are confident or perhaps hopeful about the future economy and are buying into bonds. This rally seems to be in anticipation of the Federal Reserve easing its monetary policy and making cuts in the interest rates, a move that usually aims to stimulate the economy by making borrowing costs cheaper. This could, in theory, lead to more investing, spending, and in turn, help propel economic growth. However, some financial analysts warn a word of caution. Euphoria in the financial markets can often lead to overlooking potential risks or red flags. On one hand, rate cuts could potentially add fuel to cyclical sectors such as financials and industrials. On the other hand, it might increase the risk of an overheated market or exacerbate inflation concerns triggered by the influx of cheap money. There is also an element of uncertainty in the timing of the rate cuts. The Federal Reserve's decisions are data dependent. They weigh multiple factors such as inflation, unemployment rates, and economic growth before making any strategic decisions regarding interest rates. Therefore, investors who are hastily moving in anticipation of rate cuts may find themselves in an unfavorable position if the Federal Reserve decides to delay the rate cuts or change its strategy. In a nutshell, the rallying of the stock and bond markets reflects optimism in the face of looming rate cuts by the Federal Reserve. However, observers recommend investors to act conservatively, nurturing a thoughtful and considered approach to these projections. Sporadic highs in the market landscape should entice prudence rather than inducing blind enthusiasm, highlighting the need to stay well informed in these especially volatile times.